Go. Okay, in this session, we're going to talk about annuities, mutual funds, and financial services. Pete and I are going to be covering this, so let me first bring up the screen here and take a look at what we want to see. And we want to see this, and we want to do this. Oop, and so now we're up. So, Pete, you want to chat about anything on the first page here, or just go on in?
What I like to do is that today's session is about the sales in the financial services industry, and annuities and mutual funds are the two most heavily sold products. So let's get into it.
Okay. I put this one in just to make sure that people knew how to get to, and of course, if they've gotten to this video, they've undoubtedly already know all of this, but I still just wanted to make sure on the record for the copy of the handout that we had, here's the website in terms of where we go, and walk through which workshop it is, It's Your Money, go down to the week that you want to look at, and the articles and handout material and this video should all be located there. So just wanted to make sure we have that as a front piece. Go, Pete.
Okay. Commercial annuities. Commercial annuities are issued by insurance companies and are sold by brokers firm, bank, insurance agents, etc. And the people who sell them receive a commission on based on the value of the annuity. And not only do they receive a commission up front as far as the annuity is concerned, but also what they call trailing commissions. So I always wonder when an insurance person or someone has sold an annuity policy, who actually gains from the relationship, who actually gets the annuity. Annuity literally means that you pay a certain sum of money and then for an income stream immediately or sometime down the road. It is a contractual relationship. And this is really important because insurance companies are exempt asset from the Securities and Exchange Commission. There is no regulatory body for the insurance industry. So that's why you see most insurance companies are headquartered in states that are very advantageous to the insurance company. Connecticut, Hartford, Connecticut, Hartford Insurance Company, North Dakota, in smaller states. And because that's who controls and regulates that particular insurance company. It's a contractual relationship. Well, Worth Magazine, there was an interesting fact that they said that there was approximately 12 attorneys who did not work for an insurance company who understood an annuity contract. So if you don't understand an annuity contract, you are normal. If you do understand one, then you're a little bit like Don. You're a bean counter, or you like to read the fine print.
Be careful, you're the attorney, not me.
Yeah, well, yeah. It's also, they can tell you anything and verbally. And these contracts are called the four corners. They'll have a clause in there that basically states that whatever the agent or the salesperson says has no relationship to the contents of the contract. So the contract on the what it says on the four corners of each page is what you're agreeing to. And so because they're so complicated, they have what's called a rescission period or a cooling off period. Once you sign, whatever reason, you can rescind that contract, and you have 30 days to do it. Now, compare that to a timeshare. That's 3 days. I've gone to let's see, I've gone to about 3 timeshares, and I swear to myself that I'll never go again. And the word free always gets me, that I'm going to get something free if I attend, or I'm going to get a bargain.
But as complicated as those are, you only get 3 days to rescind. You get 30 for an annuity contract.
Yeah, exactly. And
Okay.
by the way, that's for almost all insurance contracts. Okay. Commercial annuities have been around for over 200 years, so they're not new. Now, let's go to the next slide.
We were trying to. There you go.
Types of annuities. There's a deferred annuity that basically says, hey, I'll give you $100,000 today, and I'll start taking income when I'm 65. So, and then there's the immediate annuities that we pay $100,000, and in return, you tell the insurance company, I want X amount per year, and no matter how long I live, I receive those payouts. Now, who do you think usually wins? Insurance companies have actuarials, and these actuarials are very good. So they overall, whatever is left over when you die is usually the insurance company keeps. So there's a lot of terminology in the annuity area. Annuitization, for example, is a term that means that that you have agreed with the insurance company to take a set payment for the rest of your life. But that's a separate agreement than a general annuity. So there's a fixed annuity that's anywhere from, they sell them now from 3 to 5 years. You'll see them in a lot of banks. They give you a little bit more than the CD rate. And you also have to make sure that how long does that particular rate last. So even though it's called a fixed annuity, that rate is not continuous through the rate period. Then there's the guaranteed rate. You know, if I guarantee you something, my guarantee is only worth what my financial worth is. So all these guarantees by these insurance companies is only as good as their financials. And there's been a number of insurance companies that have gone out of business. Here in California was Baldwin United, Executive Life. The number 1 company in the country had to be bailed out in 2009. You know, how do you tell if an insurance company has good financials? Through Standard & Poor and some of the other rating agencies. Right. But even those rating agencies are paid by the insurance company. So, you know, it's a difficult area. A variable annuity means that instead of having a fixed rate, you can have a choice of investing in different types of mutual funds. Forbes magazine called variable annuities legally stealing. And your contract and prospectus comes out to about 3 inches thick if you want to look at it and try to figure out what's going on.
Very different. An article that you had, which is right here on the screen.
Thank you.
We originally had this at the end, so people wondering why are we talking about it now, Don? Because I put it in here.
Yeah. I just wanted you to, the audience members, to kind of see. I mean, we're not talking small time stuff. VA sales, that's variable annuities. That's when I said there was a Forbes magazine called Legal is Stealing. 26.5 billion. And that was up. And that's just for 1 quarter. you know, the fixed annuities kind of languished, but because the market was up. This is April of this year. So what do you think? What do you think is going to happen now going forward? The people are going to do the variable annuity. They just got a lot. People are fearful now of the stock market, and I'm gonna just let's see.
Oh, there you
go. Can you read that, Don?
Very slightly, because we're in small boxes in the corner, but it's a free lunch for dinner.
Yeah, and it's about is coronavirus killing your retirement? So you're going to see indexed annuities, which is another type of annuity, really being promoted, and it's considered a fixed annuity. So you don't have to have a securities license. All you have to do is be licensed to sell annuities, and you can sell these things at free dinner seminars. And so total annuity sales for the first quarter was 56 billion, one quarter. I think if you go down a little bit, do we have some projections as to the dollar amount, or is this it for the slide?
This is the second page is here below you. That's all there is. This is the whole thing.
Okay. Word of caution. This is not the time to buy a fixed annuity, okay? And it's not the time to buy an indexed annuity as well, because so many, they don't have to offer as much because there's so many individuals who are panicking. So, you know, if you see that line, investors are drawn to those products as a flight to safety, okay? People believe that this is the safe way to go, and we don't believe that. So let's go to the next slide. Annuity advantages, they're very conservative. You know, overall, index annuities, unless even though you're investing in the market, they will have probably about a 3% return. Average investment is about $100,000, and people keep them for 20 plus years. If you have somebody who knows that they have trouble saving, well, annuities have what's called a surrender charge. So anywhere from a 3 to a 7-year period. And sometimes if somebody has a hard time saving, that surrender charge keeps them from cashing that in. Some of them offer a loan, but you know, you're borrowing your own money and they even charge you for it. And again, the rates are a little bit higher than in money market rates. But if you do want an annuity, I recommend highly you stick to a Vanguard or a TIAA. One that gives very, very low commissions, or there is no commissions. And that way you don't have surrender charges as well, because the surrender charges pays the salesperson. On an index annuity, the surrender charge period can go anywhere from 5 to 15 years. So be very careful. Low rate of return, no inflation protection, commissions and fees. Internal fees are very high, and the commissions are high. Surrender charges are high. Annuities are not considered investment products, so the only thing you go by is the contract. Very limited flexibility as far as not really liquid, especially in the first 5 years. Next slide. Okay, a lot of individuals believe that when we say annuities, they don't distinguish between a commercial annuity and a charitable gift annuity. A CGA is completely different. Don, why don't you go through what is a charitable gift annuity?
So charitable gift annuities, or CGAs, as Pete just said, are mainly issued by major charities. So a large charity, American Heart Association, any of those kinds of organizations, and some smaller ones certainly, are able to issue a charitable gift annuity. Charitable gift annuities pay out a rate equal to basically the American Council on Gift Annuities. An organization sets the rate. Now you can say that's monopolistic. The courts have said, no, it isn't. It's to create fairness within nonprofits. So basically, any place you go, they're going to offer you the same rate. It isn't shopping the rate in terms of what's going on. It's generally based on either a single life or two lives. So you can do it for yourself or you and your spouse. You can set up an annuity to pay through that entire time. There is no commission. There are no fees. We talked about the 30-day delay in terms of, or cool off period for a commercial annuity. There is no cooling off period for a charitable gift annuity. Basically, there's no pressure to sell it. No one gets a commission. It's a long-term relationship that they're interested in. So you simply decide when you're ready to do this, if you want to, you go ahead and do it. It's generally a 2-page agreement, very simple, very easy, no lawyers, no nothing else are required because it's between you and the charity. The rate is locked in at the time that you establish the gift annuity. So there is no inflation coverage, recognize that, but it is fixed for the entire time of your life. It can pay out for your life or a set period of time, either single or dual life is what's an option. We've talked in previous session about crescendo. This is an example of a crescendo write-up. I just took a hypothetical. I said, okay, this person wants to give, see if I can make this work. It doesn't want to work. Okay, well, there you go. We're gonna get a bunch of them. So in this example, I said it's 500,000 they're putting in. The age of this couple, hypothetically, or when you do crescendo, they like saying, well, it's George and Martha Washington. Okay, we're going back to early people. Anyway, George is 80, Martha's 75 in this example. They would be paid 5.3% for the rest of their lives on that 500,000. In theory, I set up, just for the interest of it, a capital gain. The capital gain, they would save $32,000 roughly in terms of the capital gain. They will also, however, get a tax deduction on their income tax of $195,000. That's taken against your adjusted gross income, AGI, and they can take up to 30% of this against AGI. You can take 30% deduction. So when my wife and I did a charitable remainder trust, we got a large tax deduction. We can't use it in 1 year. That's okay. You have 1 year plus 5 more. And so you can take it over that time, but it equals to 30%. So basically, the argument is we'll save another $62,000. So in this example, by doing it, you've saved almost $100. Over their lifetime, which I think is 18 and a half years based on their age, they're going to get back almost the 500,000 they put in. But because of the tax saving, this 5.3% actually equals 7.13%, which isn't a bad return. And this is assured by the nonprofit. They don't like the word guaranteed, but basically, let's say you gave it to Chapman University. Chapman has to hold a set of money in reserve. They also have to pledge basically the entire university against this charity. So someone like Chapman or major charities are going to have a large depth of reserve behind it. Unlike an insurance company, which they could just say, we're gonna declare bankruptcy. Really, the charities can't do that. And if they did, the assets within the charity are what's guaranteeing this annuity. So that's a charitable gift annuity, which is very different than a commercial annuity.
Yeah, and Don, just so that even if a charity goes under, because I think it's important to understand the safety issue, that annuitants become before any other creditor out there.
Yeah.
This is controlled by the state of California and the Attorney General. So these are very safe. Again, though, most people will not go through the numbers. So if you're looking at fixed income and you have some type of mission that you want to give to as far as the charity is concerned, these charitable gift annuities might fit your goals and objectives.
The interesting part of this one, and Pete had mentioned actuaries earlier, Actuaries go through and estimate how long people are going to live. It's not the individual, it's the entire group. So in this case, at their ages, it's estimated they'll live 18 point something years. Typical of an actuary, they have fractional years. If they continue to live, it doesn't matter. They're going to continue to be paid. And what has happened to this industry over the years is people who do these tend to live longer. They outlive the estimated life. Now, I'm not recommending that you give to charity just so you can live longer, because Pete plans to live to 100. That's cool. I don't think if he gives a gift annuity, he'll live to 105. But either way, this is an option for you to consider outside of the normal annuity side. If you're interested in that, if you want one of these, you can fill out this form or give me this information down here at the bottom of the page, and all of this is in a handout. The information at the bottom, my email address. If you filled out this kind of information and send it to you, I will do one of these for you. And I may have questions and I'll need to send it back to you. No sales follow-up, no nothing else. I'll send this to you, and if I never hear from you again, I hope it worked out for you. If I did, if you have more questions, ask me. I'd be happy to help, and there's no fee.
So what I would like for you, not you, Don, but for anyone who's listening and watching this, you probably know more about a charitable gift annuity than 60, 70% of the professionals out there. So next time there's a cocktail party and somebody mentions that they're thinking of selling their apartment building or selling a major stock holding or anything that has a low basis, highly appreciated, or wants more income, they should at least run the numbers through a charitable gift annuity just to see what the numbers look like as to that net payout. Because in the previous illustration, the annuity was 5.3, but the actual comparison to another product, it was over 7%. Where can you get over a 7% guaranteed return? Anyway, let's go on.
The other thing that's important when you do this, incidentally, is when I did the live sessions last fall, when we were doing the nonprofit one, and even some of the others, people come up and ask me questions. Okay, here's my situation. Great, give me the information, we'll run it. And literally there was one lady that said, here's the situation, what do you recommend? And I said, who owns the asset? Her mother did. How old's your mother? 96. Is she in good health? No. I said, don't do anything. Pete has talked in earlier sessions in terms of the step up in value. I said, you don't have to give to charity. No offense to your mother. Hire a property manager to run this thing for you. And your mother isn't young. And so then when she passes, now you're going to have it tax-free. You want to give it to charity then? That's great. So it isn't, oh no, you have to do this. It's what's best for you. And that's what we're really interested in.
Yeah.
So,
next.
Okay, mutual funds.
Before we go to mutual funds, I want a couple of things. Is that if you have presently an annuity, it could be something of real value, because some of the older annuities had to have, by U.S. law, a minimum payout of 3%. And so many insurance companies increase that to 4% guaranteed minimum. And if you have one of those, where can you get a 4% return at a bank or even at an insurance company today? So you've got something really special. So you don't want to lose that. Two is that if you have an annuity and you don't understand it, and it's not paying enough, there's a thing called a 1035 exchange. And so you can exchange your annuity tax-free to another insurance company. So, and I would recommend highly that you have a fee-only fiduciary financial advisor help you in regards to that. But there's some choices out there. Okay, mutual funds. The second most sold product is a mutual fund, and a mutual fund is a very simple thing. Is a bunch of people get together and and give money to the investment manager, and an investment manager invests the money depending on what the objective of that mutual fund is. So you really need to understand when you get into a mutual fund, what is the objective of that fund? The reason why I'm saying that is that we'll learn in the investment area that not any one investment is better than another, but in your portfolio, you want diversification. And the only way you will know how well you are diversified by understanding the objective and types of mutual funds. So stock funds, we have growth. A growth fund company would be Amazon. That's a growth company. Value company would be a utility. The S&P Standard & Poor's 500 would be a sample of a blended, a fund that contains both growth and value. There are taxable bond funds. There are municipal bond funds. So let's go all sorts of different types. One of the main things about a mutual fund is that what makes them one better than another is how much you pay in expenses. So when they are sold by a brokerage firm, Morgan Stanley, UBS, Ameriprise, LPL, Bank of America, they're not going to sell you no-load funds. They're going to sell you load funds, which means commissions. And the commissions on one of the most popular funds sold is American funds. And it has a commission of 5.75%, so close to 6%. There's about 18,000 mutual funds. That's not counting internal bank funds. No-load funds, on the other hand, it's similar to a Vanguard funds. Vanguard funds do not contain any load commissions on their funds. So that's a huge savings in your first year, having a no-load. Are no-loads better than loads? Absolutely. There's nothing out there that you can get in a no-load. There's nothing out there that you can not get in a no-load fund. There are also back-end loaded funds, and that is the SEC was considering banning these, and they still may, but if we just get involved in one crisis of another, and they haven't had a chance to really look into it, but they're called B shares, and back-ended load funds. Stay away from those as much as possible. Other expenses in a mutual fund. I think the only legitimate expense is the investment management fee. Investment management fee runs anywhere from 50 basis points to 150 basis points. When I say basis points, I'm talking an interest. There's 100 basis points equals 1%. So when I say 150 basis points, I'm talking 1.5% per year. So I'm going to say an investment management fee of 1% is legitimate. People don't work for free. It's a necessary expense. The others I don't think are. 12B1 fees. They're in addition to the investment management fees.
Incidentally, Pete, just as a note, for the group watching this later on in this session, we're going to put one of these in with actual numbers from an actual fund, and you'll see how much this all adds up to.
Yeah, it's horrendous. And most people, gosh, I would say 90+% who attend the workshops for the first time have no clue whether or not they have a load mutual fund, and if they have a load mutual fund, what the fees are. In fact, most people have no clue as to how much they pay for financial services. And I think that needs to change. So 12B1 fees are what's called marketing fees for a Merrill Lynch, for Ameriprise, for UBS. How it benefits you as an individual, I have no clue. But it goes anywhere from 25 basis points to 75 basis points per year. Now, considering American funds, I'm guessing that company is worth probably around 500 billion under management. So 25, 75 basis points they just get from their participants annually to market to other people. C shares. By the way, if you see your mutual fund statement or your brokerage statement, behind the mutual fund, you'll say A, B, or C, or some other alphabet. And you literally have to go to the prospectus to see exactly what that means. But A usually means that you paid the commissions up front. So I'm going to use 10% commission just as an example. I give my broker $100,000, and what gets invested is 10% less. So 10% from 100,000 is 10,000, right? Don?
10% from 100 is 90,000.
So it would be 90,000. Yeah, so $90,000 actually gets invested. So so they're not going to give you a separate bill saying, hey, your commission was $10,000. And when are you going to see your first brokerage statement? First is either at the end of the month or at the end of the quarter. And it's not going to spell it out for you. So A is the commission for up front. If you see B shares, that's the commission that goes on the back end load that may turn into a front end load depending on how long you own the shares. And the C shares is in the industry, people are starting to become familiar with fee-only vernacular, which means that fee-only means that you're only paying your financial advisor, you're not paying them a commission. Well, a lot of times mutual funds and brokers sell the C shares as the fee-only alternative. It's not really true. It has a higher annual fee than just the investment management fee. So I call that the C for continually higher fees so long as you own it. So stay away from C shares. You know, it's kind of like, hey, you're meeting with your financial advisor in September and he recommends some changes in your portfolio. And I'm going to call him a broker. And so all of a sudden the broker recommends a C share mutual fund to you. Well, what that means to me is that the broker doesn't need any more income for that particular year, and he wants to spread his commission over the next 5 years. Okay. There's also a category called other expenses. Totally legitimate. You should avoid mutual funds that have these, and they're designed to pay for computers, offices, any other expenses. And they can charge anywhere from 25 basis points to 75 basis points per year. So to me, a no-load fund is the way to go, and you should pay less than 1%. Now, if you have an international fund, you may pay more. If you have a bond fund, you should pay less than investment management fee of half of 1%. So bottom line, always a fee. They don't do this for free, and you should keep your fees as low as possible. You can't control investment performance, but you can control your fees. Advantages of a mutual fund: gives you immediate diversification. You buy, for example, the S&P 500. You got 500 companies. You're spreading out your risk. You're not betting on one company. If you buy there's two types of mutual funds. One is a professionally managed one, where the investment manager actually picks individual stocks or bonds. And then there is an indexed mutual fund. And an indexed mutual fund is where the professional manager doesn't pick individual stocks, he just picks the index. So the S&P 500 is an index fund. And sometimes it escapes me, Don, what is a index fund that trades on the stock market on a daily basis?
EFT.
Huh?
EFT.
EF.
Electronically fund traded. EFT, I think.
Yes.
That's why we don't do investment management, Pete.
I think our age is starting to show. An exchange traded fund. That's what
there
it
you go. It's exchange, yes.
Yeah. Okay.
ETF.
Between the two of us, that's why we're both here.
Yes.
An exchange traded fund is a index fund that trades on the stock market like a stock. And we'll talk a little bit more about that later.
Well, but it's an interesting point at this point, where if you, a normal mutual fund, when you invest in a mutual fund, they don't value what you put in until the end of the day.
Right.
Because they have to look at all the things that are in it, and that's the value. Where a exchange traded, an ETF is like a stock. It's actually what's going on at the time that this is occurring. So it's a different way of looking at it.
Yeah. In the S&P 500, for example, the ETF is SPIDER. SP, I believe, is the stock symbol. And it gets traded on the market on a minute-by-minute basis. And it's very low cost. But the S&P 500 through Schwab, TD Ameritrade, Fidelity, they charge less than 10 basis points, the total cost for an S&P 500 portfolio. So it's just amazingly low compared to an American funds that starts off at a close to a 6% commission. So 6% commission versus a 10 basis points total expense for a ETF or for an index fund. The amount of dollars that a load fund has to overcome to beat a no load fund is unbelievable. Okay, what are some of the disadvantages? The average return of funds tend to be slightly lower than the market overall. Not much. I mean, you're talking basis points. You must decide on the type of funds to use. And we talked a little bit about understanding the objective of your mutual fund. That's so important. I've seen portfolios where people have 10 mutual funds, and they all invest in the same objective. That's not diversification. And diversification means safety. So in the mutual fund, you have to do a little bit of homework. If you're in the market versus having your money under a mattress or in a savings account or in a CD, the market does go down, and that is normal. So even the causes aren't normal. The causes are always different. This particular case, it's the virus. It's an epidemic. In the Depression era, it was total speculation. In the real estate era, in the 2009, it was total speculation on mortgages. So there
The
are,
dot-com bubble was
what's that?
the dot-com bubble was
Yeah.
speculation on tech companies.
Yeah, but it's normal. It is absolutely normal for the market to go down 3 to 5 times per year, 10 to 20%. And it's normal for every 3 to 5 years for it to go down 35% or more. And so you don't, when you go into the market, you need to understand that, and that you know that you don't want to sell at a time when the market is going down.
Well, we're back to the, as you had said in the first session we had, what's your risk tolerance? You can look at it and say, oh my God, it's down 10%, I have to sell. No, what was your risk tolerance? And that's where you want to go with it.
It's the
So how do
hardest
you buy
thing.
them?
Yeah, it's hardest thing to try to measure. If you're going after a stock manager that picks individual stocks, very few. I'm going to use Fisher Investments. Fisher Investments is an active manager. He picks individual stocks. Now, we have another individual, a company called IFA, Investment Fund Advisors, who did a study on Fisher Investments. And over the 5 to 10 year period, he did not beat the indexes. So, there's index, which means passive, and active, which means that they pick their own stocks. Okay, if you want to learn about the expenses, you need to understand or read the prospectus. Very difficult to understand and read. Now they're coming out with summaries that are a bit more clear. In the financial services industry, no company wants to be sued by a potential client or by a client. And so the entire financial system is based on full disclosure. If I give you full disclosure about my investment manager, about my company, and about the investment, then you, as a reasonable, intelligent individual, can make up your own mind. So full disclosure is the key to not being liable. And that's why when you read a prospectus, it has every possible negative scenario can happen with that stock or with that company. It is boring reading. It is 6-point, 7-point type. It's on parchment type paper. But once you're handed that prospectus, I've given you full disclosure. You cannot rely, I didn't tell you, okay? So, and it will have a page in there on expensive, and it's one of the most important areas to understand. And if you can't understand it, it's normal. So you get your broker or your financial advisor and say, explain that to me again, okay? I love, there was a Denzel Washington, I'm thinking it was in the Philadelphia movie on AIDS, and they were sitting at dinner, and he kept on asking the other to explain things, and it was so convoluted. He finally said to him, pretend that I'm 7 years old. Now explain it to me.
Right.
And I thought that line was absolutely awesome, because many a time brokers try to speak in vernacular that is lingo language, and it's not understandable. So you tell them, hey, pretend I'm 7 years old, make it simple, make me understand. Types of families or mutual funds, and how do we figure some of this information out third party wise? So Morningstar is an excellent resource. Lipper Mutual Funds is not as popular today as it used to be. Value Line is not as popular. Professional advisors and we'll go through that in a little bit. But Morningstar and Yahoo Finance is probably your two most used today. And most libraries will let you use their computer and have these services for free.
Okay, we're going to switch subjects. So let me bring up that presentation. There and there. When we did this session live, Wes Long had done the presentation. There were issues with the visuals and some other things. So we've adapted from that presentation, gotten hopefully some better visuals for you. So we're going to go through this one as if it was Wes in terms of what all we're going to cover. But what's FINRA?
Yeah.
FINRA is a self-regulating organization, SRO, which goes through and says, if you have a question, for instance, if you want to do broker check, I want to look up my advisor, or my investment advisor, I want to look up the firm I'm going to deal with. You can go to broker check, and we'll show you examples of this in a few minutes, and get information about them. Have they had charges brought against them, complaints, whatever else it happens to be. As you will see when we go through here, an organization may say, okay, I'm not admitting anything, but I'll give you $10 million to make this go away.
How it happened, the Securities and Exchange Commission is in charge of all financial matters. However, what they did was create an SRO, the self-regulatory organization, and says, hey, you regulate your own brokers in your industry. It's kind of like the medical profession doing the American Medical Association and saying to the American Medical Association, now you control all medical doctors in the United States. This is FINRA's is the self-regulatory organization for all brokers and all financial advisors, and I'm going to get to that in just a second. It's made up of Merrill Lynch, Bank of America, UBS, Chase, Morgan Stanley. Every major broker, they govern themselves. They set their own rules. And it's all based on that full disclosure requirement, because that's what the SEC demands. So every single person and every firm is listed on broker check. So you have a broker or financial advisor, you plug in their name or their CRD number, and full disclosure happens. Now,
So
this,
go ahead.
yeah, this is just it blows me away every single time I see it. Morgan Stanley, it has 131 disclosures. A disclosure is a regulatory issue, problem, or an arbitration issue award against the company. Now remember, Morgan Stanley is in the business of managing other people's money, not their own. Yet, one, they don't have the best interest standard. They have what's called the suitability standard. And they still have issues.
So as an example, this is one item. I'm sorry?
Good. Why don't you go through it?
So each of these is a particular item that happens to have been a concern or a complaint out of this 131 items. So we'll drill a little bit into it. We're not going to spend a lot of time on each one of them. But this is sort of just a summary in terms of here's a concern or here was an issue. One thing I want to note, however, is this is page 1 of 70 pages of information about only Morgan Stanley. So this is one page. This is a brief summary of all of this, which I'm not even going to begin to read to you in terms of the concerns and the issues and everything else about it. the summary, in a sense, becomes this. They were fined $10 million for a particular violation of how they were dealing with penny stocks, which is one of the more entertaining, scary, whatever parts of whatever you want of the brokerage industry. But for penny stocks, they said basically, you know, we don't admit to anything, but we'll pay you $10 million to settle this dispute. Now, the money, the $10 million, did not go to the people that owned the penny stocks. Interestingly, it went to FINRA. FINRA is the self-regulating organization. So the people who put this all together and said, watch us, are getting the money when they've penalized somebody. Now, that's not to say that they're going to do this unfairly. I'm sure that this was absolutely justified of whatever they were coming through with. But the issue you face is, these are the kinds of fines that are paid. Now, who pays that? Well, the firm paid it, but ultimately it was probably paid by someone who was an investor, or all of the investors in using Morgan Stanley. That's where it was. I mean, where else does the money come from? It's their profits. Well, they're going to charge you.
Yeah, what's really amazing is that this $10 million had no impact on their earnings.
Oh, no, none.
None. So it gives you an idea. And Morgan Stanley does business every single day here in the community. Merrill Lynch, who sold derivatives to our treasurer, still in business today. In fact, it's all about selling. It's the Las Vegas concept that, hey, we don't care how you bet, just bet, because we're going to get the juice.
Right.
And so every single person and firm needs to be listed with FINRA. FINRA acts on behalf of the SEC, providing full disclosure. When you put someone's name or firm in broker check, if they're under a brokerage firm, you'll go under FINRA. If it's an individual who is just controlled by SEC, i.e. does not take commissions, is not a salesperson, they get regulated under the SEC. Then there's even more complications. If you have a amount of dollars below, I think it's 100 million, you're regulated under state law. If you have over 100 million, then you're regulated by the SEC under national law. So it is very confusing. But the main thing is, your the person that you're dealing with, you want to look them up on broker check before you do business with them. Or if you haven't looked them up and you're doing business with someone, it's a good thing to check them out.
So just as a note on this particular one, so Merrill Lynch agreed to an acceptance, a waiver, and consent. So they're not admitting to anything. So this is their AWC. So on December 26, 2018, the firm and FINRA entered into an agreement, an AWC agreement, in connection with an allegation that the firm failed to develop and implement an anti-money laundering program. Okay, and this is off the penny stocks. So that's what they happen to be accused of, and they agreed to pay $10 million and fix the problem. That comes in later on. So Pete has talked about firms. Now let's look at an individual. So broker check, if you put an individual, the name of the individual, what firm they're with, and if you happen to know their license number, you can put that one in. Here's an individual. Now, I could look at Merrill Lynch and say, national firm, lots of years, they shouldn't have that many, but they do. This is one person who has 16 notations against him. He's been in the industry for 31 years and has been with 8 different firms. So here's this nice little chart down here that shows back in 1990, he was with Kidder Peabody, Whittier, but all of these red dots are these 16 complaints against him. So what are those things made up of? Well, let's look at it. So this is another summary page, which lists the fact that there were 2 regulatory events, 1 criminal act. I'll just cut to the chase and tell you that in about 10, 15 years ago, long before it was legal, he was growing pot and got arrested for it, has a criminal record. There were 11 complaints from individuals. There was one termination. He was fired at one point, and he has a financial issue. That's right. He declared bankruptcy. But that isn't noticed generally, right? The people, remember this? He worked for all of these firms, and in the middle of this, he declares bankruptcy. He's arrested for pot growing, all these other things, and yet firms kept hiring him because of things that he did for them. So this is, for instance, here are all of the things listed, and if you click on them, you wind up with these kinds of information, and in this case, making material misstatements on an application for registration.
And that's
He
why
lied to the people who were hiring him. He didn't tell them he'd been arrested. Okay, so that's, those are the kinds of things that this guy does. But if you don't look at it, you don't know these things about these people. So goes through, UBS came through. Oh, I'm sorry, the other one wasn't that. That was a different one. This is the fact that you didn't tell them they'd been arrested when he went to work for someone who hired him anyway. But then again, they ultimately decided to terminate him. After they hired him, they then terminated him. So this is an interesting broker from the standpoint of where we're going and what we're doing.
But this is an extreme case. I want to mention that right up front. But the idea being is that it's very difficult to be fired if you're successful in getting people to trust you. So brokers do everything possible to have you trust them. So how do they do that? Well, one is they join their local church. Don't ever take a referral from a fellow churchgoer. That's a joke, but half serious. They belong to the Kiwanis or the local Chamber of Commerce. They, send their kids to Little League, and they try to be as trustworthy as possible. They have designations behind their name. Financial services industry has over 150 different designations. Why does this industry have so many? Well, the more designations you have after your name, people seem to trust you more, even though they have no clue as to what you did to earn those designations. So be very careful.
The fact that here's his bankruptcy, incidentally, but if you do broker check, you can find out who this person has been in the past. Yeah. You can't find out if they're a good investor, but you can look at these kinds of things and say, gee, what do these things mean and when were they occurring in terms of what's going on? So
two huge things that you need to do when somebody wants to sell you a product or wants to talk to you about their money. One, ask them to complete that Ask First form. Two, look them up on Broker Check. Find out, do they have any disclosures? I would never do business with someone who has a disclosure, especially if it's involved with a sale of a financial product. Oppenheimer, for example, Oppenheimer Mutual Funds, 1 out of 5 of their brokers have a disclosure. It's just mind-boggling. 20% of their sales force have disclosures. A disclosure, think of a disclosure like a speeding ticket. It's either a regulatory or they literally took advantage of a consumer. And by the way, it's not easy to file a complaint with FINRA. Most times you have to find an attorney. An attorney is not going to accept your case unless there's a lot of money involved. So even just to be on FINRA with one disclosure is a real negative.
So as an example, we stole from Wes, we're using from Wes. These are his materials about himself as an example. So and we're not picking on him because he's outstanding or something else or unusual. Here's a good indication, I think, of, in this case, down across the bottom, he has no disclosure information. Now, I'm sorry, I jumped past this fairly quickly. So he's been involved in the industry since 1990. So 30 years he's been in the industry. He's been with 1, 2, 3, and now 4 companies, where the other guy had been with, I think, 6 or 8 and had 30 or 18. Wes has no disclosures. So from that standpoint, Wes is what he says he is, and this is the information about him, and not promoting him, hyping him, or anything else, but as an example, this is what you would rather see if you went in to look at a particular agent that you were going to work with.
Yeah, one of the biggest FINRA complaints is that they don't disclose enough, one, and two, why does FINRA allow individuals who have 18 or 15 disclosures to continue to be in the financial services industry? And
I'm going to bring you back to that one in a minute when we talk about another part of the topic. So I'll bring you back to that one. So that's what you want to do. You want to use broker check, or you want to be able to go through and look at this and say, what is it that the firm is doing? What is the individual doing? And that's critical to you to valuing it. You mentioned Oppenheimer earlier. This is a different part of it, but this breaks out some of those expenses that Pete was talking about. So do you want to talk through this one?
Sure. This is never, the names that they give these mutual funds or annuities have nothing to do with what the reality is. So they're just marketing terms. GE, when they were in the financial services industry, had a annuity called Secure Horizons. You know, say.
Then it became an oil platform off Louisiana.
Yeah, it's just the name has nothing to do. You've got to go to the Morning Star and find out what the mutual fund is all about. But this one is Growth Opportunities Fund. You just ignore the name. It's a Class A share. So A means that you pay a front-end load or a front-end commission. This one is 5.5%, 5.5%. Annual expenses. Now that's on top of the commission. So it has 90 basis points, a little less than 1% for the investment manager. It has 12B1 fees, so that's for marketing. It has other annual expenses at 22 basis points. And then it has an annual fee waiver and an expense limitation of 13 basis points. And who knows what that is. Okay. Many of these things are just, you'd have to ask somebody in the accounting department to know, what does this actually mean? So expense calculations, what do the real dollars mean? Because this is the $40,000 is your money. So $2,200 went to the commission. So net invested was $37,800. So you're not putting in the complete 40. The management fee after 1 year, 340 to 12B1s, it's listed all there. Go to the next page. Look at the bottom line number. First year, you've already lost 7% just in expenses alone. Compare the S&P 500 with a Vanguard or with a Fidelity or with a Schwab, an index fund. You would have lost 10 basis points. 10 basis points of $40,000 total expense would have been what? $100. Isn't that right? $400.
I'm sorry, I was reading something.
I know.
I wasn't paying
attention to me, and you know, it's
a magazine,
and it's interesting. I try to be. Now, it is just so amazing the amount of money that these brokerage firms charge, and then the alternative is so inexpensive.
Well,
okay.
I mean, as you said in the name, this is a growth opportunity fund, and in year one, without doing anything, you've lost 6.67. Forget what the market was doing around you.
Who was the opportunity for?
Yeah. And
who was the growth for it? Okay. In remember, the financial services industry is a sales organization, okay? Everybody is involved in sales, selling bonds, selling securities, selling mortgages, selling partnerships, selling credit cards, selling something. In the mutual fund area, after you buy a certain amount in one fund family, they give you what's called break points, and it reduces your overall fee. So if you're with American funds, for example, and you're investing $1 million, if you stay within that one fund family and diversify, you will substantially lower your fees. So just be aware of that. Order flow payments, how quickly do they buy and sell? It's an internal thing. I wouldn't worry about it, but it's another expense that you're paying for. Stock loan revenue is the same thing. They trade off between funds and they make money there. There's also sales contest. You know, I've seen free trips to Hawaii, free dinners, golf outings all over the world. And so when I ask a financial advisor to fill out that Ask First form, I ask, are you involved in any sales contests at the present time? Because it's always for, let's say, a Bank of America or a Merrill Lynch. If they have a bond sitting on the shelf or an internal product that they have developed, they can afford to give a higher commission and a trip if the broker sells that particular bond. So remember, you're walking into a car lot when you're walking into a brokerage firm, whether it be Wells Fargo Advisors, a Bank of America, etc. If you want to, bonds are the most, and we're going to have a whole session on bonds, but bonds are more opaque. They're not as transparent as securities and stocks are. So Michael Lewis wrote the book called Liar's Poker. And if you're an individual, I would never buy an individual bond as a consumer. You just have no clue as to what's going on. Anyway, here's some bond sites that will help you with some of that activity. I'm not going to spend too much time on it.
We talked about, if you look at that individual that we showed all of the different violations and whatnot, you ask yourself the question, why do different firms keep hiring him? Why do they hire you? Because he keeps selling. And if he sells, they want him to come to them. So what they'll do in a lot of cases is if you change firms, they may say, listen, if you come from that firm to my firm, we'll pay you a bonus for sign-in. And it could be 3 times what he earned last year. And we'll look at what you did last year and we'll guarantee you that, or give you a bonus based on that to get you to come in. And they're basically buying people in because it is a sales program. And if you are in fact a good salesperson, different firms want you to be there because you're good at selling. But
yeah, and you also bring in over a whole portfolio of clients.
And a whole bunch of people will come with you because they're going to say, you know, the broker is going to call you up and say, wow, you know, the firm I've been with, I suddenly discovered they've got issues. I'm going over to this other firm where they're absolutely fantastic. And here's what I'm going to do. And here's where we're going to go together. So you're going to bring a book of business with them when they come in. Some may not, but most of them will probably follow them. Guaranteed payout, end of year bonuses, all kinds of things, because they're salespeople and they want sales to occur. Yeah, okay, the guy might have had some problems in the past, but he's told us he's going to be good now. Okay, so they keep hiring them. So for the one firm that actually fired him, I got to give him credit. They actually got rid of somebody. That's impressive.
Compare it to real estate. You know, what is the bar to get in to become a real estate agent? To take one, I believe, one exam, and to be hired by a real estate agent firm. So how does the real estate agent get paid? Well, when you first start out, you have to depend highly on the brokerage firm, First Team or Coldwell Banker, for their expertise because you're brand new. So when you sell a house, let's say the 6%, 3% to the buyer, 3% to the seller, the agent doesn't receive that 3% in total. That 3% gets split between he or her and Coldwell Banker. Now, when you first start out, you know, it may be that the agent, the person receives 30% and the firm receives 70%. And as you go up and gain experience, knowledge, and have a following of clients, wow, it could be, you know, completely reversed where you're keeping 70% of the commission and 30% goes to a Coldwell Banker or a First Team. The financial services industry works exactly the same way, okay? Every broker negotiates with Merrill Lynch, with UBS, with Bank of America, with Wells Fargo, as to what that split of the commission is going to be. And the higher book that the broker has under their umbrella makes these upfront bonuses in the millions of dollars. And with the guaranteed payout and the back end bonus. Now, does the broker tell you that I've just changed firms and because of a higher payout to me? No. They'll tell you, oh, this is a better firm. They're offering better research, nothing about how the person is paid. And that's, from my point of view, one of the most important things you need to figure out quickly. I'm not going to go into that. It's literally, you know, it's making money on lending money out, you know, on
your money.
On your money.
Yeah. Okay.
Oh, by the way, before we go on, annuities and mutual funds are sold by very reputable individuals. And what I mean by that is many individuals have no clue as to that they're doing anything wrong or if there is an alternative. For example, if you go to your credit union, you can act like a bank. You can borrow money for a car purchase. Some have for loans for housing, and all good price. Well, guess what? They also have a brokerage firm. They also sell annuities. And I've asked many an individual at a credit union, ask First or First Credit Union for teachers. And the people behind the counter have no idea of the commissions that are being charged on some of these products, or that the person is a commission salesperson, not just there to help you with your money. Anyway, go ahead, Don.
So that's annuities, mutual funds, and financial services. The following week, it happens to be this from when we're recording this following, excuse me, this following Friday will be the first of 2 weeks on financial planning, then medical care, investing with using bonds, stocks, in your mind. So that's the rest of the 8th series that we're on. We thank you very much for being here.
One other thing is that,
this is Pete and I in big screen. Yes, Pete, you wanted to say?
The only thing I was going to say is that we've now focused in on the sales part, and now we're going to get into the area where how you should be investing your money.
The detailed pieces of that. And so we thank you very much. We hope we've helped you with some things, covered some subjects. If you have questions, you have our email addresses on the handout material. Again, these will all be at the on the Finance and Estate Literacy website. We thank you very much and have a good day.